It's that time again. Let's recap on a week in markets. Delighted to be joined today by Paul Durrans, our investment director. Quite a week in markets, Paul. Equity markets continuing to demonstrate strength. A lot of the strong GDP and economic growth data supporting that trend, particularly the labour market report from last week. But in the same breath, that strength in economic growth and the inflation reports this week are driving a bit of volatility in the bond market as well, in terms of the timing and the magnitude of interest rate cuts, which we can expect from here. But what were your key takeaways?
Well, I think, from an investment perspective, what's really encouraging is that equities have extended their year-to-date gains this week. We've seen the US equity market, which is the dominant within a global equity portfolio, has reached another record high, and it remains that the growth economic environment remains quite supportive for equity markets, and that continues to be the case. We continue to receive data that suggests that the US economy is remarkably strong. So we look at a nowcast data series that suggests that the US economy is growing 3.2% in the third quarter. So real GDP is also reaching record high levels. So very constructive from an equity standpoint. But as you say, bonds has been a little bit more volatile because economic growth has been so strong, and therefore we started to see interest rate cuts expected by the market beginning to be priced out. So that's causing a bit of volatility.
And we also had the minutes from the Federal Reserve's last meeting, and
Yep.
that was the meeting where they've reduced interest rates by 0.5%. Was there any interesting examples in there?
I suppose in aggregate they agreed to cut interest rates by 0.5% last month. I suppose what the minutes highlighted, that there was a number of members that were more of the opinion that they should cut interest rates at a more gradual pace. So rather than 0.5% cut, some wanting a 0.25% cut. Mm-hmm. So it is at the margin, and that came through in the minutes. And actually the markets didn't react too much to the minutes, more still digesting the strong labour market data that we had a week last Friday, and then also focusing more on what's coming through in the US inflation report that came out on Thursday.
Yeah. What were the key takeaways in the inflation report?
Well, I suppose in the inflation report was at the margin a little bit disappointing. For context, inflation has been slowly grinding lower, which has been encouraging, and actually central banks, the Federal Reserve, have been less concerned about the inflation picture and more thinking that the balance of risks have shifted towards the employment side. But looking at the details, headline inflation dropped from 2.5 to 2.4%, slightly above what the economists were expecting. We also really focus on core inflation. So this removes energy prices, food prices can be quite volatile. That actually ticked up from 3.2 to 3.3%. But when we look at the details, we break down the inflation basket, it's that services side which is remaining problematic. You're seeing shelter prices, transportation services prices remaining quite strong. Looking forward, the challenge is that because energy prices have been pulling down on inflation, actually we've seen oil prices increase over the last few weeks, and so that may pull up the inflation level going forward, and towards the end of the year we could be trending slightly higher around that 3% level, which is 1% higher than where the Federal Reserve wants to get to.
It's quite a challenge, isn't it, for the central bank at this point in time, because you've got a number of components which are ebbing and flowing. One of the aspects which has been persistently sticky is that shelter component as well, and it's also really important to take a longer term perspective in terms of the direction of inflation. So we've been talking about a theme of disinflation, which is essentially inflation coming down sort of closer to the central bank target whilst economic growth remains resilient. And on a longer term perspective, we are seeing a lot of evidence of that playing out in the economy.
Absolutely, and we're seeing it in prices, inflation basket, but also in wages. They're moderating. We're seeing continued gradual cooling within the employment market, which would give you confidence that prices should settle lower. It's just where they settle. Do they come towards that 2% level or remain where they are at that 3% level? So it is challenging for the central bankers, and they are very much data dependent. And various data points can be quite volatile in nature, so it is a challenge.
Speaking of volatility in the data prints, we've got the UK economy, which is back in expansive territory, ahead of the budget, which is coming up in autumn. Any key takeaways in the UK?
Unfortunately, we're not seeing wild growth in the UK, but we have positive growth. And so today we had the latest report that showed that in the month of August, UK economy grew 0.2%. Now, not a lot, but better than what we saw the 2 months prior to that, where we saw zero growth. So we have seen, the UK is set for positive growth in Q3, but it is a step down from what we saw earlier on in the year. The challenge is really for the UK, for the labour market, for the Labour government, is they need real positive growth in order to really spend more. And it remains still challenging if you think where the Labour government wants the UK economy to get to. They're wanting growth to be at 2.5% each year. That's a big task for them, especially when they're talking about tax increases. For context, the 10 years before the 2008-2009 crisis, you had the UK growing on average at 2%. They want to get to 2.5% today. Last year, the UK economy barely grew at all, so it is a challenge.
Well, if you think 2.5% is a challenge, China, they want 5%. And we know they've been struggling to get there with the challenges they've had in the property sector, which were as a result of the officials trying to reduce the level of debt in that market. Yeah. And now they're trying to reverse course a little bit. They're trying to re-stimulate the economy, and they unleashed a number of actions in September, or started to open up discussions of these to really stimulate through monetary policy, to improve households and their spending abilities, but also the ability for financial institutions to access liquidity in businesses across a range of different sectors. We're going to find out a little bit more this weekend, I believe, but the market reaction so far since that initial discussion in September has been very strong. But any sort of key expectations of what we can expect to hear this weekend?
It's, the market's already moved quite a lot. Valuations were depressed, sentiment was depressed. A lot of asset managers were underweight the region, and the market's moved 20-25% in a very short order. We've seen a bit more volatility this week. We've seen a noticeable drop at the start of the week after the Chinese holiday came to an end. And really, it's dependent on how much fiscal stimulus they're going to throw at it. And those details should come through over the course of the weekend. They're talking about 2 trillion, 3 trillion RMB in local currency terms. So that's what's kind of expected. It's also important is those fiscal measures that get announced, how they directed. Is it cash payments to the consumer, where they can spend those straight away and it gets straight into the economy? Do they allocate it into areas where the multiplier effect is strong? Or is it a bit more piecemeal, a bit here and there, not very targeted? A lot we'll find out, and we'll certainly keep you up to date next week.
A lot of information there, but a few takeaways. We've got strength in economic growth that is underpinning a lot of the support we're seeing in the stock market at this point in time, and we're seeing that come through in a broader range of sectors across the market and regions as well. We've potentially got a tailwind there from China in terms of what they're doing to stimulate their economy once more. We're seeing a bit of a volatile picture in terms of the inflation backdrop, and that's driving some volatility within bonds. But taking a step back, we're still seeing a number of aspects which are constructive of inflation starting to cool further from its current levels towards the targets of central banks. So, yeah, quite constructive actually for multi-asset as we look ahead. Thank you very much, Paul. Great insight, and we look forward to bringing you up to date next week. Thank you for watching.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.